All right, we are all live. Welcome, guys. We've got some people that are coming in now, which is awesome. Just for a start, can we just go into the chat bar and just find out where people are from? We're currently sitting in Auckland at the moment. It'd be good to find out where other people are tuning in from, just while we're waiting for the last few people to come on in. See, Andrew's plugged in there from New Plymouth. Good to see someone that's not from Auckland, Andrew, and then Tom's in here from Auckland as well. So, yeah, just as we come in, guys, if you can just put some info in the chat bar, and then we can. I suppose the thing with tonight is the more interaction that we get, the better this webinar is going to be for everyone. So, and from Mangawai, Tauranga, Hamilton, Wellington. So, we've got a bit of a spread tonight, which is really good. So, Susie from Melbourne, g'day, Suze. So what we'll do is kick things off tonight with the main agenda and what we're looking to achieve. So tonight's going to be a bit more of a Q&A session. We've got some topics here around the debt to income ratios, how they're affecting people, what that future lending looks like. And then just at the end, some strategies that we're sort of looking at to build some confidence. And then also a Q&A at the end. So as we're going through tonight, there's also, beside the chat, there is the Q&A only section. If you want to put your questions in there, then we'll get to them at the end. If there's something that's sort of pressing and hot on point, I'll ask that question as we go. But otherwise, we'll put that in the at the end there. So before we get into the introductions, the other thing that we've got going tonight too is just some polls that'll pop up. And so what we've got is our first one here is just to get an understanding. We know where you guys are coming in from, but it'd be good to get an understanding of the investment properties that you've got. Have you purchased an investment property or no, I haven't? And then these numbers come up live as we sort of go. So at the moment, we're looking at sort of 33% of people have purchased a property, 66, we're back to 50-50. So we've got a fairly good split at the moment as to where things are sitting. So we've got a mixture of both. And those guys that haven't bought property before, make sure you get your questions in while you've got the opportunity to do that. So just while that's kicking off, just to introduce myself, Hadley from New Zealand Property Buyers, for the people that don't know me. Started investing myself back in 2006, 2007, just before the GFC, which sort of for me, sort of 2021, 2022, or 2020, 2021 anyway, had the same sort of feeling in the air as what it did back then. So been through the peak, been back through the trough, and then back out the other side and learned a whole lot of stuff along the way. And now it's really great that we can help people from those previous experiences. And I suppose the biggest lesson through that was just learning how to have a really good team around you. And hence the reason tonight why we've got Simon and Zhang from Mortgage HQ here. So it's really important to have a great team around you and experts that can help you out with with your journey. So a quick bit about Simon and Zhang, and then I'll get them to elaborate themselves on this as we go. So Simon bought his first home and income when he was just 20, and then he's moved on to building duplexes and a backyard of another home. And now he's moving on to much larger projects where he's getting family and friends involved. So when it comes to advising clients around developments, he knows what he's talking about. He's no stranger to that. And he's found his true passion in helping others to get great results in property. And Zhang's been named the top five mortgage advisors by NZ Advisor 3 years in a row. And so I'm really what really impresses me with Z is that he's a big picture guy. He does what he says he's going to do and actually purchases property, just doesn't talk about it. So currently he's got high cash flow multi-unit properties in the regions. And then he's also working on a 7-lot development here in Auckland. So really, really excited to have these guys on. And I'll get you guys to add in anything there that I've missed.
Zhang, would you like to go first? No, I think you've covered everything, Hadley. Appreciate that. It's a hell of a introduction, Simon.
Yeah, pleasure. Yeah, thank you. I appreciate the kind words.
Cool. And so just before we sort of get into the questions and the sort of main part tonight, these guys are both registered financial advisors. That's what they do day to day. But anything that we talk about tonight isn't personal financial advice. It's just general advice from the thousands of clients that Mortgage HQ and these guys have dealt with over the time. So if there's like personalized questions like how much can I borrow, what should I do, go and get in touch with one of these guys and say, hey, this is my personal situation. Can you give me some advice? The webinar is not quite the right place to jump onto that. So kicking things off, and I think probably one of the big things that has come out in recent times, other than the high interest rates that we've had, the debt to income ratios and how they've sort of had that effect on the market. So do you guys want to sort of tell us a little bit about how they've come about, maybe why they've come about, and what sort of impact that they're having on people?
Yeah, I guess I'll go first. Z. I think at the moment there hasn't, apart from sentiment, when it was coming in, people were like, oh no, a bit scared. I don't think it's actually taken any effect. Every calculation I've done with all my clients have shown zero effect so far. Yeah, I'll leave it at that for now. Z, do you want to add anything?
Yeah, I think, no, you're right. So I think with the test rates being so high at the moment, basically the maximum borrowing capacity for a family usually is dictated by the test rates as opposed to the DTI. So yeah, there's not much effect from what I've seen so far.
Okay. Is that going to sort of change, do you guys think, when or as interest rates start to drop down? Is there like a point where DTIs start to kick in and interest rates or test rates start to come out of things?
I would say, yeah, I think so back in 2021, I'm not sure if you guys remember, some of the banks actually tested the DTI policy. Right. So BNZ back in 2021, they actually had that policy in place. So at that time, the test rates were about 6.5%, right? And that's the sort of place where we will see DTIs sort of have an effect. Yeah. But whereas test rates at the moment, we're looking at 8.5 to 9 with most of the banks. So right. There's a long way to go until we're going to see much of the DTI take effect, I would say.
Yeah. Okay. So there's probably the people that are worried about them. There's probably a bit of fear in the market or misunderstanding that's been sort of put out there rather than like actual issue that we're potentially going to face with this in the near term anyway.
That's correct. Yeah.
Yeah, cool. And so sort of with that, the lending sort of situation, is that changing at the moment with interest rates coming down and things like that, or what are you guys sort of starting to see out there from the lending side of things?
I'll go again then. I think a trend perspective is something that I'm seeing, and so there's a couple of things that's happened. You would have known, obviously, the LVR changed, so that there's a couple of things that are in the servicing test rates and several different things that different banks are doing. So the trend is that we're seeing an easing from a lending perspective.
Right. Okay. In is that in terms of criteria and in terms of like how much the banks, like, are the banks open for business and happy to lend people at the money at the moment, or are they still quite conservative and worried about what's going on out there?
I'll give you some specific examples.
Yeah, cool.
There are some banks that are now using where previously banks would use your full credit card limit and assume that you're making the minimum repayments as part of a servicing criteria. Some banks are actually saying you can keep your credit card and we're not going to assume that you're going to max it out and use that as part of the servicing criteria. So this is just one example of several things that have happened. And so, yeah, I think it's along with the lowering of the test rates, the lowering of the LVRs, and more specifically with how the banks are treating those, and it's flowing through to some of the policies in a overall easing. I wouldn't say that it's gone from hard to easy. All I'm saying that it's hard and it's slightly less hard.
Yeah.
So there's a couple of metrics that are pushing into that direction.
Yeah, cool. That makes sense. Sachin's got a question here that I think is quite relevant too. In terms of like when we talk DTIs, in terms of the income side of things, are the banks scaling the income, the rental income, or is it a case of like they look at all your debt as a whole and then all your income as a whole and then sort of work that out on obviously the DTIs haven't come in, but is that sort of how it's prefaced, or sort of thoughts on that?
The DTI tool is something that's actually variable, so
Okay.
it's not fixed. At the moment, they've got it's set in place where, from my modeling, it's not going to make any pinch until about that 6.5% servicing test rate. But watch that space. I think what's going to happen is that the market's going to dictate when the DTI will bite. It's not going to be the other way around, aka the Reserve Bank pulling that back up because of where we're at in the market. We're going to see an easing, I think, and from their perspective, and it's not until we see some other factors like maybe oil price or some other factors that will influence inflation, where we have some up and down of the rates and the trend. But if we don't have that at all, in terms of the rearing ugly head of inflation, I think that the trend will be similar to other trends, which is an easing of policy and lowering of interest rates. And then we all know what happens after that. It may take some time this time around because of some other factors, but house prices usually follow that.
Yeah. Okay. And just in terms of like your take on it, see, with these DTIs coming in, is that going to have some control? Do you think that we're not going to see a skyrocket in people's serviceability or ability, like a repeat of like 2020, 2021, where everything just shot for the moon, and when test rates dropped, people's ability to borrow went up as well?
Yeah, 100%. I think just to answer your previous question as well, Hadley, are lending rules getting easier? Yes, they are. And the reason, what's happened is obviously the Nationals come in, right? And what's happened is the previous government, the triple CFA was overprescribed. Yeah. So a lot of these policies that made lending harder, they're being reversed by National. Yeah. So, and then obviously when it comes to the DTI, answer to that is it's going to put a stop to people. And it's a good thing, right? I don't see it as a bad thing, because what's happened in the last couple of years, in 2020, 2021, a lot of people, they could get around some bank policies, and some of the people that they got, they had their DTIs at like, even 9 to 10, maybe 11.
Right.
Just by getting around bank policy, right?
Yep.
And those are the people that are coming off the interest-only periods at the moment, and they're all coming off to, principal and interest. The rates are going higher. They've got 10x of their debt. 10x of their income is debt. Right. So property prices have also come down. So what can they do? They can only, sell their property if they're not in a good position to service the loan. So yes, I think it's a very good thing to have that DTI there, so that, there's other levers that we can play around with lending, right? So whereas previously the only thing that dictated your maximum lending was the bank servicing calculator, right? Right. If you passed it, the bank will give you money, essentially.
Right. Okay. And that was just potentially changed too on just sort of how much business they were doing and how much new business they wanted to get in the door. And then there was quite an easy adjustment that happened thereafter.
Yeah, that's great. Yeah.
Yeah, cool. And so just before we jump on to the next question, we'll just get some more attendee involvement. So we've got another one here. I'd just be interested to see other people's thoughts on what they think interest rates are going to do moving forward. And the poll's up now, guys. If you can just put your thoughts on, do you think interest rates are going to crash back down to COVID levels, where everyone's going to try and get drunk on property again, and go back to the. Well, that was a pretty quick 100% no. That's that's popped up there, or do people sort of think we're heading for sort of a 4.5% OCR, and we've got a couple of yeses and a couple of no ideas that are popping. It's always interesting to get everyone's sort of take on how this goes. I'll leave that sitting there for a bit. But what do you guys think in terms of future rates? Are we talking quick cuts? Are we talking an easing over a period of time? And we're crystal ball gazing here, but just for I suppose every barbecue talk that every barbecue that you go to, everyone's a pro on interest rates. So we thought we might as well ask you.
I think, Simon, you're the more macro guy. I think you should answer this question.
I think this is a hard question to ask, and I have some theories, and usually when I go down this rabbit hole, it's very late at night, and I've watched a couple of videos, and I should be going to bed. But no, I think that there's been a long trend, and the Western world has been drunk on this long trend, and it's fixed a lot of problems, right? It's just kicking the can down the hill, down the road. Is there anything that's going to stop it? I'm not convinced. If you have a look at all these other civilizations that have gone in this direction, it ends in one way, and that's nothing good. And so I don't know if there's anything that will reverse it. The question is, like, how long will it continue for, and how does it go when you're at zero? What happens there? And so I've got a theory. And I don't know how I'm going to be taken from this, but there has been some experiments when you go to zero and even below zero. We saw that in Europe in the last crisis. And so I do think that with the evolution of cryptocurrencies and the adoption of central bank cryptocurrencies, what we might see is the adoption more and more into that. You can see it already. Australia, US, the reduction of cash, right, from society. And if you have a look at the top echelons of where all the money is, institutions, governments, right, and you have a look at the reliance on subsidies, whether that be people on the dole, or all the way through to companies that require subsidies from governments, right, whole industries requiring it, countries. And so if they have control by way of central bank digital currencies with these metrics, the majority of the cash or the majority of the money flow, the only thing that's really left to control if they switch to central bank digital currencies is velocity. And so let me ask you this question. Have you heard from these types of institutions, the likes of, you shouldn't be spending your money on this and you should be spending your money on that, and we're going to put subsidies here and not subsidies there? I'll give you some examples. Electric vehicles, all right? Don't eat the cows, eat vegetables and tofu, and the cows are farting and all this kind of stuff, right? And global warming, we've got to do something about it. And so I think there's going to be a push for people to want to control that in ways. And I'll get back to my point about velocity. The velocity aspect is this. Here's a certain amount of cash for the person on the dole or the subsidized business or the industry. Now you have to spend it on these certain things, and you have to spend it within a certain time frame. Yeah. So that actually solves that issue that you had, and with these other experimental countries like China and Soviet Union, where they lost the price indications that the economy in the West has through capitalism. So I think ultimately, to wrap this all up, I think we will find an experimental time frame again when we get to the disaster period, where we go into the zero and below in terms of interest rates. I just don't know when, but that's my theory, is that we will go in that direction. The long-term trend will not change.
Yeah. Cool. Makes sense. See, anything else you want to add on that, mate?
I think it's pretty hard to add to that. Headley.
Yeah. Cool. So in terms of from that, what's the confidence are you guys seeing out there at the moment with your clients at the moment, and sort of what they're looking to do and execute on with those sort of things in mind? I mean, we can see that the trends on interest rates are coming down. Are you guys starting to see a bit of confidence coming back in through clients, or are people still sitting on the fence, or what are you sort of seeing there?
Yeah, I'll answer that, Simon, and you can add to it. I think the confidence hasn't grown back to where it was. It's certainly gone the other way in terms of there's more confidence. However, we're not. It's not, the rates haven't dropped significantly, right? So the rates went from low 2s all the way to 7. Now it's only starting to go the other way, right? So, and it's going the other way pretty quickly. Like we've seen the rates drop, almost 1%, and since the peak, and it's half of that was done in the last 2-3 months, right? So we are seeing it go the other way now. In terms of confidence, if we look at the rate itself at the moment, it's still 6.19%. So most properties that people are buying, they're still not going to be cash flow positive, right? So I would say yes, there is more confidence, but it's not like 2021 levels. And
makes sense. I think it's also interesting just with that too, that there's that the old saying of what Warren Buffett's when everyone's greedy, be fearful, and when everyone's fearful, be greedy. Not saying that greed's the thing that we should be chasing, but in terms of that, when people are out of the market, it seems to be the fact that everyone else runs out of the market as well. And I tend to use an analogy with the likes of Briscoes, that you'd never go and buy anything at Briscoes that wasn't on a Thursday, Friday for it's Saturday sale, or it's the following Saturday sale. But it seems to be the opposite with property, is that property goes on sale and everyone runs the other way and then waits till the sale's gone and then goes, oh, now's a great time to buy it at the peak of the market, and then it drops and then people go, oh, property doesn't work.
We see that a lot, Headley. I mean, obviously, one of our biggest years was 2021, right? That's when the rates were low. And, now we're on the other end where rates are high. People are still buying property, but not with the same confidence.
Yeah. So
we're seeing the best deals come on the market these days, Headley, right? Like back in 2021, clients that came to us that were bringing us 6% yield deals, we thought they were great, right? Yeah. And now we're seeing 9%, 10%, sometimes even more than that. So, like you mentioned, now is a good time in terms of to find deals, at least, right?
Yeah, makes sense. And so, what do you guys, from like a finance perspective, what are you sort of encouraging clients to do at the moment in terms of like setting themselves up? Either they've bought some property in 2021, and obviously just general advice here rather than people's individual circumstance, but like they've bought some property in 2020, 2021. They're going, there's some good stuff that's out there at the moment. What sort of stuff should they be thinking about and doing to get themselves set up to sort of carry on purchasing or set themselves up well from like a serviceability perspective moving forward?
Yeah. One of the biggest things that I find hard to try convince people of is that when you've bought a property up here and it's come down here, that selling isn't the worst thing in the world, especially if you're buying something else. What they can't get their head around is that bought it for $1 million, it's now worth 800. If I sell it, I lose 200. Not necessarily. What about that property that was $1 million that's come down to 800? That was double the rent or double the yield.
Yeah,
it's a great buy now. Trade out those properties if cash flow is that much of an issue. Right, and so there's plenty of options to do that for people. It's just not looking at in isolation that one property that they've purchased. Some people are more susceptible to see the facts and the figures. As we all know, we're as humans, we're not that actually convinced on facts and figures. We're much more convinced on the emotion and the feel. And the sense that I lost out is a lot harder to swallow than the reality of the situation. So, but but the people that do take action, we've had amazing results with clients that have traded out some of the underperforming assets with the help of others to acquire assets that are much more higher performing and to upgrade and supercharge their portfolio.
Yeah, makes sense. We've just done something similar with a client where they had a pre-approval for 900 grand. There's been a property that we sat down and went through their whole portfolio and looked at it and went, what does that portfolio look like? What's the worst performing property? Even though like this time might not be isn't the best time to sell in Auckland, is like, well, for a $1.1 million house in Auckland that we were getting, $800 a week rent for, can we sell that, take $800,000 out, use that as a deposit for something that we're going to get, now 2.6 million worth of lending, and we're going to get $4,000 a week for. But like you say, it's that mindset thing of like the property should be worth 1.4 or 1.5, but we're selling it for 1.1, 1.2. But the upside of that is that while the market's quiet, we've got those other and better opportunities.
You've just doubled down on what I said, where you've actually upgraded the lending and exposure as well. So when someone comes back to you and say, oh, but what about when capital gains starts to return in Auckland? Well, that was $1 million property. You now got 2.6 million in the regions. If this goes up by 4.5 and that goes up by 6%, you're still going to do better on 2.6 exposure than 1 million exposure. So people's capacity explodes when they sell an underperforming asset at 3.5%, 4.5%, and getting 9%, 10% yield. So I'm 100% behind that.
Yeah, so that sort of a change in minds, that sort of mindset, and sort of to lead on from that, what sort of deals are you guys seeing coming across your desk at the moment? Are people sort of more attempting for the cash flow side of things, or are there some really good deals in Auckland that people are finding at the moment, or what sort of I suppose go-to is not the right word. I'm sure there's a variety of stuff that's coming through, but what are you sort of seeing in terms of in general?
Yeah, I'll answer this, Simon. I guess when it comes to, in general, because the rates are so high, most investors who are investing in long-term rentals they're going for high yield properties.
Yeah.
Right. So when I say high yield, I'm meaning more than 8%, 8.5% sort of thing. Right. Yeah. Because from a general standpoint, I think 8.5 is when you're going to see properties become cash flow neutral at the moment with today's interest rates. Anything above, that's when we're going to start seeing properties become cash flow positive, right? Because the rates are so high and everyone's cost of living is going up so much. That is the flavor of the month, I would say. High yielding properties. But there's also other people going for flips, for example, and that's a short term thing, right? They might buy something, add some value to it, and flick it off with a margin. So there's a mixture, I would say, but your average Kiwi that wants mum and dad investor, usually, the advice that we're giving them is, look, you do want to find something that is cash flow positive if you can.
Yeah, and so that's going to help them with that serviceability, sort of long term, and help them keep going.
Correct.
Yeah, cool. And in terms of like for you guys when you're sort of talking to clients, because I know with talking to people myself, there's either people seem to get hung up on two things. They either like everything needs to be capital growth orientated, or people tend to be sort of all I want is cash flow. Are there some pitfalls that people fall into if they're just sort of targeting one and one's their sort of go-to?
Yeah, I get a lot of clients saying to me, look, I'm just stalled. I don't know what to do. I've got this option that gives me capital gains. I've got this option that gives me yield. And some of these clients actually have capacity to do and move forward. They're just don't know what step to take. And so what we do and what we do well, I think, is start with reverse engineering some of their goals. Why are you doing this in the first place? What are you trying to achieve in the long run? And by reverse engineering that, it becomes very clear what the type of property you should be going for, right? You've got some strengths, you've got some weaknesses. Say one of those weaknesses is your equity, then it's obvious you go for the equity gain type property, right? And so by going through that process with clients, it becomes evidently clear as to the path they should be taking.
Yeah, cool. And I think it probably comes down to that thing of like just having a conversation with some people that are gonna, give you that advice as to where you are, because you try and navigate this yourself. You're forever guessing as to what things might be or how things may be, or you're listening to Uncle Jim at the barbecue who hasn't bought a place in the last 20 years. Cool. And so in terms of for you guys yourself, and I'll just sort of ask each of you, how you, in terms of your own confidence in the market at the moment, are you guys thinking about buying? Are you sitting tight? What are your sort of thoughts at the moment?
Yeah, for me personally, Hadley, you know me as well. We work together, so I think timing the market is a very it's a very beginner thing to do, right? Because you might be an absolute beginner and you might time the market perfectly, but you might think that you're an expert by doing so. So I think my principle is you always need to just buy with the right fundamentals, right? Because property investment, it's a long-term game, right? You might buy really well and you might lose money though.
Yeah.
But on a 10, 15, 20 year scale, that's when you're going to see the difference in property, right? So in terms of timing the market, I choose not to. If a property comes on my desk and it's a good property, good fundamentals, then then I'll take action.
Yeah, makes sense. Simon, yourself?
Yeah, I think it was just yesterday or the day before, Ziyang posted something in one of our group chats saying, "Hey guys, let's go for this one." I think it was a very expensive unit complex, so he was maybe asking for a little bit of a help, maybe a joint venture there. But yeah, some of those fundamentals, and this is why he posted it, were really good. So look, there's a lot of deals out there. I'm personally in the market for looking for something. Both Z and I now have a major consideration and stakeholder to consult every time we now go for additional properties. My wife and Ziyang soon to be married. So that probably slows things down a little bit. But I don't know if it's a bad thing, because maybe that's a risk reduction model that we have to balance between us. Z and I think, are both quite we like the risk and we like to move forward with that. My wife, I can speak for her if I can, not so much. So maybe having that balancing is a good thing. But I'm personally been working very hard over the last couple of years to increase my income so that I have capacity to continue going. I dug deep to get into my last development, and it was just after the peak, and so I got 50% of the reduction in the latest downturn. So the numbers for the development aren't looking as good as what it was when I purchased it. And at the time when I purchased it, I thought maybe we're close to the bottom, but we're kind of only halfway there. So had to pivot and readjust and work on the income side of things. Now I'm there and I'm ready to go for something that's going to balance the portfolio a little bit. I'm very heavy at the moment in Auckland and capital gains and development properties. So looking for something out in the regions with some small development potential, because I've got a team around me that can do some renovations and small developments. So I want to leverage them. I want to get some stuff underway, but ultimately the end game is those fundamentals from a yield perspective.
Yeah, cool. Makes sense. I mean, I think the other interesting thing too, as you say, it's something that we're seeing with clients at the moment, and we have been for the last little bit, is just working out, what those cash flows are and how long they last. Like how long, if we are having to top up, how long that's for. Because I think it's probably something to, definitely look at. Everyone just looks at like the first year, and then there's $2,000 to top up, or $3,000 to top up in the first year, and they go, it's negative. So I don't want the deal. I don't want anything to do with it. But then they don't look at the equity position that they're putting themselves in either, and look at it as like the overall. So I think it's probably the important thing, if I pick up what both you guys are saying, is that we need to be looking at things like over a 10-year period, and that if we've got 12, 18 months of having to chip in a little bit, and we're not talking thousands of dollars a month, but a couple of grand a year to get ourselves there. But year 10, things are getting us to where we want to be. It's definitely that case of not getting rich overnight, and playing the long-term sort of game there. Cool. We've got our last couple of quick things here. A couple of questions that have just come in. This one here from Andrew is, what risks do you guys think there's any, and this might be a bit of a touchy one, but thoughts on if interest deductibility is going to be taken away? Are you guys at all worried about that, or you just head down and if the right deal comes up, then we're investing, and we'll worry about that later?
Yeah, I think the thing with all these policies, right? If you invest in property for a long term, over let's say 15, 20 years, there's going to be so many different policies that come and go, right? Yeah. Rates are going to go up and down, policies come and go. So the thing is, I don't think you should let those things dictate your investment journey, right? And that often does. And the reason for those policies to come in is to dictate the market, right? Yeah. But I don't think you should, because it's always going to change. Someone who's back in 2022 when they removed the deductibility, right? A lot of people didn't buy property because of that. But what's happened 2 years afterwards? They brought it back in, right? So yeah, I don't think if you're buying the right properties with the right fundamentals, I think you shouldn't worry too much about those things, in my opinion.
Yeah. I think the other thing with that too, Andrew, is one thing that we did when the market changed. I'm always a firm believer of how can we make things work rather than finding out the reasons that we couldn't. So when it came in, I basically went through the announcement to find out where the tax breaks were, and at that time, basically we weren't going to buy new builds, but we were going to go up. But social housing was there, and so it was a case of just reading everything I could, picking up the phone to everyone I could, and go, "What do you know about the social housing thing? Who do we need to contact to get involved with it? And if we do this, is that going to give us our deductibility back?" Which it did. So that then became our strategy for clients to move them forward, was the thing of how are we going to make this happen? If everyone else is put off by it, fantastic. But government generally tends to drive tax relief where they want people to invest money, and that's generally where it tends to go. Hence the reason why they put a whole lot of tax incentives around new builds, because they saw that there was the housing crisis. So if we want more people to build more new builds, we need to give tax incentives for that to happen. Cool. Can you guys explain a little bit about JVs and in terms of how would funding? I know there's a question there, sorry, answer about the legal stuff, but that's probably more so something we'll have to talk to your lawyer about, or a lawyer about. But in terms of yourself, Z and Simon, around JV funding, is it easy? Is it difficult? One person's got money, the other one doesn't. One person's got income, the other one doesn't. How does that? Is it a tricky situation or something that's fairly straightforward?
Okay. So there's a couple of ways to look at it. It depends on how complex those two people's situations are that are coming in together as well, right? If it's two people that have got nothing and two people are bringing cash and they're buying the one property, that's easy, right? But if one person's got debt, right, and they've got a partner with that debt, and that partner wants nothing to do with your crazy friend who you want to go in to do joint ventures with, and they don't want to do any linking guarantees, then what you're going to see is that there's going to be some problems with the fact that that debt is going to be practically roped in. Now, there's a couple of ways around this. One of those ways that you can go about it is, for example, forming an LTC and having the bank or non-bank review this in isolation and just the LTC. the problem with that is that they will only use the income that the LTC derives. So the income is the income from the property. So that deal has to self-sustain itself. And so where do you bring the other money from? You bring it in from cash. So this person will have to top up their mortgage. This person will have to top up their mortgage, bring in the cash to the LTC. The LTC's lending can then be used to self-fund those projects. There's a couple of other ways that can do it. But what I'm finding is that usually in these joint ventures is that there's professionals that know exactly how to do it and how to leverage it. And then there's, I don't quite have equity and my servicing is not that great. And then this person over here has everything. And then it's like, I'm talking to this person, it's like, you don't need that other person. You can do it yourself, kind of thing. And so that's where I'm usually seeing is joint ventures from a lot of my not so experienced clients are there's usually one person that's really holding up the other person.
Cool. Anything else to add on that, Sam?
Yeah, I think with the joint ventures as well, like how it's structured, there's a lot of ways you can structure a joint venture, right? There's no one size fits all. It could be one person bringing all the money and all the equity. The other person brings all the expertise, and it's really how you negotiate that with your joint venture partner. But from a borrowing perspective, it also depends, right? Like, are you buying a long-term rental together? Are you buying a short-term to flip? You're buying a development? Like, what are you guys doing, right? So it's really hard to answer that question. But for me personally, when I give that advice to my clients, generally speaking, if clients are going in a joint venture with, let's say like, you're a family and you've got another family and you guys want to join forces and buy like a long-term rental together, that is something I generally tell my clients to avoid. And the reason for that is because it's not a very efficient way of allocating debt, right? Because everyone that joins that joint venture is actually equally liable for all the debt, right? So you might only have half the property. Like, let's say, me and my partner go along with Simon and his partner. We buy a property together. Each of us are actually 100% liable for all the debt. So when it comes to me doing my own things, let it on the track, it's not an efficient way of us doing things, if that makes sense.
Right. So you can actually like hinder your own serviceability by jumping there, thinking that you're going, right, I've only got to put in half to this property so that I can go and do something else. But in actual fact, you'd be better off to go and buy it yourself because your serviceability is impacted the same for half the profit.
Exactly. And if you can't do it yourself, maybe you want to go for something smaller, maybe something cheaper. Right, but a lot of the times, and it also comes, when you want to borrow money against that property again in the future, you need everyone to sign on, against the additional borrowing. So it gets a bit tough.
Right.
Yeah. So I mean, there are cases where it does work and it's very good, but in most cases, generally speaking, it's something that I tell my clients to avoid if we can.
Yeah. Okay. Cool.
But, to add to that, short term is great because you're going in, you're going out. Right, you're making your money, and that's fine. We're leaving, but then long term is a different story.
Yeah, cool.
There's also I'd like to add here as well is that I don't want to shy people away from having that conversation with their financial advisor, especially an experienced financial advisor who has got skin in the game and has been doing joint ventures and the like. The reason being is because when you speak to a financial advisor that's got experience in these kind of things, they can provide essentially a framework for a discussion document to then go back and speak to the relevant parties, including parties that you have to pay to speak to, like accountants and lawyers, and give you much better holistic advice as to what is feasible and possible without wasting a lot of money and time and effort going and seeking this advice from the likes of lawyers and accountants. I'm personally working with a client at the moment who lives in the UK, and him and his wife have got a clear relationship property agreement. She has additional investment properties in the UK. He has one investment property in an LTC here in New Zealand and wants to continue buying. Now, initially there was some undisclosed information about the fact that their relationship property and their personal owner-occupied property in the UK has joint debt. Now that we know that, I've said, hey, look, I'm definitely not a lawyer and accountant, but here's a possible way you could look at this. How about your two entities raise 50% of the debt and lend you personally the money to pay off that debt? You then, instead of having to be 100% liable for the entire debt, you're now only liable for 50% of the debt. Now you can go again under the LTC. He's taken that information, gone to the accountant, well, first the wife, then the accountant, then the lawyer, and got it all signed off and is ready to go, pre-approved. So I think what we've done there is provided a lot of value for these clients to have these ideas, but refine them before going and paying for the experts to write the finer detail.
Yeah, makes sense. I think it comes back to the sort of what we were talking about earlier, is like talking to people, finding out how we can do things rather than, sitting there and going, it's all too hard, or I can't do it. There's generally always a way. We've just got to, figure out what that way is and move forward from there with asking the right people. Awesome. Cool. So that nearly brings us to the end of tonight's session. So really appreciate your time, Simon, and Z as well. Always appreciate it. To everyone out there that's listening, what I'm just about to do is put a couple of links in the chat here, just for the Mortgage HQ YouTube channel, our own YouTube channel as well. So Blandon's got a whole lot of, or Blandon and the guys got a whole lot of really great content in there. We post all of our webinars that also go up in there as well as a resource for everyone. So it'd be really great if you could click on them, subscribe, give us some insights into what you're thinking and any queries or questions that you've got. JT's just come up with a final question here that says loan to value ratios. That's one thing we didn't talk about tonight. Just quickly, LVRs, where are they sitting at the moment, and where are they going to go any further? Are we going to see the 80% days again, do you think? Another crystal ball gaze.
I assume you're referring to 80% for the investment property.
Right,
yeah, I don't know. I mean, who knows? I don't really think equity's that much of a problem. I very rarely run into it. It's usually the people that are entering the market, and usually the parents have got quite a lot of equity. So there's actually very little times I run into the problem. To answer Jeremy's question, in short, no, it's not 65-35 at the moment. It's actually 70-30. So 30% for investment properties, 20% for owner occupied, and we're seeing the likes of 2.5%. I know it sounds crazy in some circumstances, but mainly between the 5 to 20% mark for owner occupieds and 30% standard for investment properties. It's not to say that investment properties can go slightly higher than that at non-bank lenders.
Cool. Awesome. That seems like everything for tonight. Just the final thing just from us is that I've got a link that I'll post up in here on the side, just with a discovery call with myself. So 15 minutes if you want to sit down, have a chat, figure out where you're at the moment and where your property portfolio might go, then happy to have that. That's all complimentary and it'll take you through to my calendar. And so we've just got a few limited spots there, and I've opened up a little bit more in there for next week. But guys, great to have you. Really appreciate your insights. If there's anything, there's a couple of personal questions that have popped up in here tonight. Best thing to do, reach out to Ziyang, reach out to Simon. They'll be able to answer the questions for you, get a bit more insight into your own personal situation, and give you some more of that personalized advice.
Thanks for having us, Hadley.
No problem. Any time at all. Thanks so much, everyone. And reach out if you've got any questions, and enjoy the rest of your night.
Good evening.
Thanks, guys.